Robert and Jamie, when it comes to accounting best practices, can you walk us through some of the different methods of accounting? And you don't have to fight; you guys can just pick and choose which ones you want to jump in and talk about. But why don't you kind of let's start there with the foundations of accounting.
I'll defer to the CPA in the room to start this conversation.
Okay.
Excellent. So first, we'll just go over the two main methods of accounting.
Okay.
Which are cash basis and accrual basis.
Okay.
Cash basis is more common among smaller companies, and that's where you don't recognize, or you recognize the revenue expense based on the cash you receive or the cash you pay out. And so it's very hard cash oriented. You're recognizing revenue when the cash comes in, not when accounts receivable comes in, but when the actual cash comes in, and you're not recognizing the expense until the cash is directly paid out, and not necessarily payable. Whereas the accrual basis is where you're recognizing the revenue on a kind of, you're matching the revenue expenses with the time that they happen. And so you may have a 2-year contract for $10,000 in year one, and you're going to recognize that revenue in year one.
Okay.
Because you received that contract in year one. And whereas the cash basis, you would receive only the cash you received in year one, and then the cash you received in the year two, the final year of the contract in year two.
Okay.
It makes a huge difference in this industry too, especially when you consider that the average collection period is something like 76 days, I believe, this year.
Yeah.
So there's a huge difference in how you're accounting for it, because there's so much time that passes between invoicing and receiving.
Right. Okay. And Jamie, Claire, why don't you, just to kind of take it a little bit further, but given all of your experience with a wide variety of firms in the design industry, with these two different methods of accounting, cash basis and accrual basis, which one is preferred, or kind of a hybrid of them both being used?
Well, I would actually say a hybrid method is the most commonly one. Most firms will recognize revenue on an accrual basis, so when the invoice goes out, when it's billed, and then they'll recognize expenses on a cash basis. I would say it's called modified cash.
Modified cash basis.
Yeah.
Okay.
I think that's probably what we see the most often, and I think it makes the most sense in this industry too.
And there's that fancy word again, EBITDA.
EBITDA. It's a magic word, isn't it?
It is a magic word, and just for the interest of our audience, why don't we talk about EBITDA just a little bit, just so they have a better understanding, because people flout that word around, and I honestly believe
it's a fancy word.
It's a fancy word, but some people use it and they still don't know really what it means, and that's why I think it's kind of cool just to break it down. And on the video, what we'll do is we'll kind of give some images to show and really elaborate on what you are describing, but just so the audience has a better understanding. Why don't you kind of break it down in its I know it stands for different things. So
yeah, and so to get to EBITDA, let's just first get to operating income. You're going to do revenues minus direct labor and minus other operating expenses, general admin, and expenses that help you run your business on a day-to-day basis. So that gets you to operating income. And within those operating expenses, you'll include interest and taxes and depreciation, amortization, and that's where the EBITDA comes from. The E is earnings before interest, taxes, depreciation, amortization. Okay. And so your operating income, and you want to add back those expenses because, for one, the interest and the taxes are going to be different across regions and across different tax jurisdictions. Right. And interest is something that's not really correlated with the operation of your business. And then the depreciation and amortization is not a cash flow expense. It's an annual expense from an asset that you purchased, and it changes with the type of depreciation method you chose to use for your business. So it's not necessarily, you're not paying anything that year, it's just expensing an old asset year after year. And so it's not necessarily an expense, it's reducing a fixed asset.